We're joined by Julian Callow, the chief European economist at Barclays Capital. Thank you so much for coming in, Julian.
Yeah.
There is still so much concern because actually yesterday's bond auction went well, but at these levels, it's going to be a lot more difficult going forward for these countries to finance themselves. Are you concerned that we are going to have more bailouts and actually this is just a very temporary relief?
I think in the case of Portugal, it's going to be very hard, really, to avoid some form of external assistance here. Now, if you look at what's been going on, there have been the reports coming through that the European Central Bank has been buying debt, including of Portugal, during the course of this week. So although the Portuguese debt auction did go well, I think still the market is going to have a lot of question marks there. With Portugal, we're dealing with a budget deficit that, if you exclude the special one-off measures that were undertaken late last year with Portugal Telecom, then the budget deficit was probably still running around 8.5% of GDP. So there's still a very large amount of adjustment. I suppose one thing is that during the course of this year, we'll know if countries like Portugal and Ireland are actually going to make it in terms of having to achieve this very large degree of fiscal consolidation that they're planning for this year. In the case of Portugal, it is around 4% of GDP. It's also around 4% of GDP this year alone in the case of Ireland. And so we'll have a much better idea about whether these economies really can withstand that and the deleveraging and the other problems that they've got.
Julian, I know you've also published a major report. Yeah. It's difficult also for bankers. What does your report actually find that surprised you?
OK, well, I guess we did this report really starting last summer, trying to, first of all, analyse what went wrong in monetary union and then how you could actually fix it. And clearly, there has been some timidity on the part of governments, on the part of policymakers. What we think are the three big problems are, first of all, major competitiveness deterioration, particularly in the periphery. I'd exclude, in fact, Ireland from that, but that's certainly true for Spain and Portugal, and I would also include Italy there. Secondly, very large growth in private sector debt, and that was particularly strong in the case of Ireland. If you actually add up the government debt, the household debt and the non-financial corporate debt for Ireland, at the end of 2009 it had gone up to 390%, which is way higher than any other country we've got there. So there were debt problems when particularly residential prices have fallen already 40% from their peak in the case of Ireland. Commercial real estate prices have fallen a lot more. And finally, then you have the public sector debt problem as well, which we were mentioning earlier. Debt GDP ratios are escalating very, very sharply in many of these countries. Now, it's very hard to put all those things right at the same time. If you're having major fiscal tightening, that's going to weaken demand. That's going to make your problems with private sector debt much harder to deal with. At the same time, if you've got a lack of competitiveness, the solution which Germany adopted in the last 10 years is actually to cut unit labour costs. But that's deflationary. Again, that's going to increase your debt servicing burden. So I think the markets really have been seeing these three issues there and just wondering how it all pans out. But we think there are solutions that can be undertaken. You have to really give these countries a lot of support. It has to be conditional support. Major labour market reform, major fiscal reform, and in return they should be getting much lower borrowing rates from the rest of Europe. And the EIB has a role to play in injecting a lot more stimulus into these economies.
Julian, thank you so much. Julian Callow there.